Good morning, everyone. Welcome to another Tax Tuesday. This month's topic is year-end charitable giving and deduction strategies. So if you're an individual taxpayer, a business owner, or a high-income earner looking to be more intentional with your taxes, this is a great one for you. Our purpose today is really simple. We just want you to be in control of how much you owe and how much you get back. We believe taxes should not be a mystery. You should understand exactly how the tax code applies to you. Everyone's situation is very unique, so treat this as an education, not specific advice. If you have specific questions, feel free to put them in the chat. We'll get to as many of those as we can. If we can't get to your question, we'd be happy to do a kind of year-end tax planning question and answer with you. And as a quick reminder, you can register for all of our future Tax Tuesday sessions at mullintax.com/webinars. Outside of tax season, we do them every month. And then during tax season, we actually plan to ramp that up to once a week. So it's a great time to be face-to-face with an advisor, get some questions answered. So let's go ahead and jump in. So why does year-end tax planning matter? So most tax savings disappear at midnight on December 31st. Once the year closes, you can't go backwards. There's actually very few ways you can go back and change your tax situation after December 31st. There's retirement contributions. Kathy, can you think of any other ones that you can do after January 1st is passed?
Retirement contributions like 401k and those kind of things can be up until the deadline of the return filing, which is in most cases April 15th for individuals. But that's really about the only one that you can deduct after 12/31. It's like the witching hour.
Yeah. So now for the next month and a half really is the best time to get your year-end tax planning done if you want to impact 2025. If you're okay waiting to 2026, go ahead and meet with us in January, February, March, April. Happy to consult with you then. But most tax savings disappear on December 31st. Once the year's closed, you can't go backwards. Charitable contributions must be made by December 31st to count for this year. There's no exceptions. A lot of people wait till April to think about taxes. Like I said, there's not much you can do. So today is what we still can do, and the earlier you act, the better. So before I turn it over to Kathy, I want to lay the groundwork a little bit, talking about itemized deductions versus standard deductions, because this is really big when it comes to charitable contributions. A lot of filers used to itemize before the Tax Cuts and Jobs Act, but then that standard deduction increased pretty substantially, where it just wasn't super helpful. Most people, when they do charitable contributions, it added a little bit, but it didn't get them above that standard deduction threshold. Now with the One Big Beautiful Bill, that threshold has continued. I believe I put in, there we go. Here's the standard deductions for 2024 versus 2025. So you can see for single filers in 2025, it's $15,000. Married filing joint is $30,000. So that's a pretty big hurdle to get over. The nice thing is if you own a house, there's SALT tax, state and local taxes. There's now no longer a $10,000 cap on that. It is now $40,000. So if you have done charitable contributions in the past and you have that SALT cap getting in your way, you may be itemizing this year. So it's worth at least assessing to see, is it worth it or not? But I'll get that out of the way. A couple of things just to note, what does qualify, what does not qualify. So it needs to be done to a true charitable organization. So this should be a 501c3. There's other nonprofits. That does not mean it's tax deductible for you. You can use the IRS exempt organization tool if you're unsure of what type of entity. We hear a lot of people saying, oh, I donate to this organization. That's a $50,000 deduction. Well, unfortunately not. They don't have a nonprofit status. It's the wrong type of entity. A lot of times a GoFundMe or a Venmo, political campaigns, things like that. A lot of times those do not qualify. But also documentation. Documentation is critical when it comes to charitable contributions. We don't see this a lot, but common enough where the IRS comes back and says, hey, we're just going to disallow your charitable contributions just because they don't think they're valid. So it's up to you to prove to the IRS to say, yes, these are valid. Here's my receipts. Here's my documentation. So whether it's a receipt, it could be a bank statement, Sometimes it's appraisals on larger ticket items or non-cash items. So the burden of proof for documentation is on you. The IRS is not just going to take you at your word. So that's a really big thing, especially if you're talking larger donation amounts. If you're talking $1,000, $2,000, they're probably not going to care. But once you get to 20, 30 or more $1,000 a year, that's when we more frequently see the IRS come back and say, nope, we're just going to disallow these deductions, even though they are valid. You then have to prove it. Anything else on that one, Kathy, before I hand it off to you?
Just with documentation, it's always best to keep it at least your 3 years while your return's open for audit. Because even if they don't disallow it,